Okay, and we are live. We'll give it a few seconds before everyone joins. Okay, I think we can start now. Great. Hello, everyone. I'm Gayatri from Index One, and I'm joined today by Chris McAfee, Craig Camille, and Oren Soni from BX. Index blends are benchmarks created by combining several market indices with fixed weights so that the benchmark reflects the asset allocation of a diversified portfolio rather than a single asset class. Instead of comparing a portfolio only to an equity index, a blended benchmark may include indices for equities, bonds, and other assets in proportions that match the portfolio strategy. This allows investors to measure performance against what a portfolio with that specific allocation would realistically be expected to achieve, and also makes it easier to replicate the allocation using low cost index funds or ETFs. Their use has increased as portfolios have become more diversified and as passive investing has grown. In the United States, index blends are widely used in multi asset portfolios and model portfolios managed by financial advisors. According to Wisdom Tree and Investment News, by April 2025, third party model portfolios had climbed to about $7.96 trillion in assets under management, which reflects increasing advisor reliance on pre built and diversified frameworks, often constructed from index funds and ETFs. And as of late 2025, ETFs in the US market has grown to over $11 trillion in assets, and advisor allocations to ETFs are expected to rise toward about 25.5% of client assets by 2026, surpassing mutual funds in popularity among advisors for portfolio construction. Index funds are now commonly used among several areas of the investment industry. Wealth managers and financial advisors rely on them in model portfolios for client accounts. Institutional investors, such as pension funds, use them as policy benchmarks for strategic asset allocation. Robo-advisors use them to construct automated ETF portfolios, and retirement products, such as target risk and target date funds, use them to benchmark diversified portfolios. Overall, the rise of multi-asset investing, passive investment vehicles, has made index blends a standard approach for both portfolio construction and performance valuation. BX offers the US large cap model, which is a blend of two BX indices calculated by us at Index One. This model combines a size based large cap core index with a dividend growth and yield plus momentum index, creating a portfolio grounded in size, income, and growth. And when blended, the model extracts US large cap exposure across different segments of the market, combining size, dividend yield, and momentum to mitigate the weaknesses of each individual strategy. The result is a smoother return profile with consistent outperformance. Craig, can you walk us through the process of building the model from this universe of selected strategies?
Yes, thanks, G. What BX and Index One began as a quest several years ago was to find an alternative to static or traditional passive index investing, and to see if we could find managers, research firms, and strategists that could outperform their benchmark and or generate alpha. And so during a typical year, we'll interview 100 to 200 managers from around the world, and collectively they will have 1,000 or more strategies that we'll look at all the different strategies, and we'll eventually whittle that down. So far, we whittled it down to about 70 strategies that have gone through our funnel of due diligence and what we're looking for. And that includes 20 plus different money managers or research firms that we work with that help us design these strategies slash indexes, because all of the strategies that we've created are on an index structure versus an SMA structure. And we partner with Index One to do all of that. So a lot of the due diligence, the back testing, and the review is in partnership with G and Alex at Index One. So that's our quest. And so we then wind up with this big basket of strategies that we believe, based on our due diligence, will outperform their stated benchmark over a market cycle, which is a pretty aggressive quest and a pretty aggressive statement. But we really wanted to see if we could find outperformance, because if you think about it from a client perspective, if you can make an extra 1 or 2 or 3% per year, it changes the likelihood for that client to wind up with a lot more money when they retire or when they need it. So what happens next is we kind of go from this due diligence to the next page, which gets into so then what do we have? So we currently have 65 active strategies that are run by 22 different firms, and that's what we call our ingredients. That's what we have to work with. An investor can invest in any one of the 65 strategies as a solo strategy, but we think it's very important to find the right blends to create the model, which G talked about earlier, is this massively growing part of the industry where clients and financial advisors would really like to have the ideal model, the ideal ingredients assembled for them, so that you get the right correlations and the right counterbalances so that you get the optimal performance. So we currently have 24 live models that have been built off of these 65 different ingredients. And those can be found in a variety of places, but we like to embed them into existing tech stacks, so it's very easy for financial advisors to use. And then that gets into, well, all right, so that's great. Well, how is this all performing? You guys set out on this quest to find outperformance. So on the next page, we show, that within these models that I was just saying, we have 24 of them. At the present, 100% of them are outperforming their benchmark from 2025 and 2026. And the reason that is that there's this diversity of thought, meaning we're bringing together firms and teams that look at things and run their systems and their engines differently. And in between finding the best ingredients, finding the right correlations and the right weightings, we've so far been able to build very efficient models as it relates to client success. And then lastly, I just want to talk about our team. So we've got a global team, people based in Europe and in North America. But really, everybody on the team has 25 or more years of product experience. In some cases, a lot more than that. We've been studying fixed income and ETFs and SMAs and structured products and building them and selling them and using them for years and years and years. And so we have a really strong understanding of what works and a really strong team as far as how do we put together optimized models. So I'm going to turn it over to Chris McKeffy now, and he's going to talk about how we optimize actual models, like a little bit more detail behind the scenes.
So the first thing that Craig spoke about is the BX deselection process and creating this universe of outstanding strategies that we believe are all capable of outperforming their benchmarks over full cycles. And we've been very successful at doing that. Like 80% of our strategies have outperformed their benchmark over 3 years. So we've got, when the BX Portfolio Solutions team goes to work, we've got these outstanding ingredients to work with. Now, having outstanding ingredients is a necessary but not sufficient, right, set of conditions to create optimal blends. So what you have to do is then determine the objective of the portfolio blend that you're trying to create and figure out which pieces are going to fit together the best to create the best risk-adjusted return solution to achieving that objective. So in this case, what we're looking at is our Alpha Seeker model, and this was put together very purposefully, and it is performing outstandingly well. and it's continued to perform outstandingly well. And it's just a blend of 5 different BX strategies designed to deliver US all cap equity exposure. So we've got a high octane growth momentum sleeve in here. We've got a very well thought out large cap value sleeve in here. We've got a tactical sleeve in here to provide some risk management that kind of offsets some of the volatility in that growth momentum sleeve. And then there's a SMID sleeve. And you put it together and you've got a portfolio that has shown outstanding outperformance versus cap weighted benchmarks with substantially lower volatility over time. And so what the team does is we look at it, say, what's the objective? What pieces are likely to fit best to achieve that objective? And then you do kind of a smell test. Like, does it feel like these pieces fit well together? And does it make sense that they're helping this blended portfolio achieve its stated objective? So that's a big part of the process. You run the back test, and then if we could actually fast forward to slide number 13. So what you're going to see here on slide 13 is another huge component of what we believe, which is that there's such a thing as there's a tremendous potential diversification benefit in terms of producing outstanding risk-adjusted returns. You can't have a correlation matrix like this in a cap-weighted index world, right? So you look at these these pairwise correlations, they're all 0.6, 0.58, 0.7. Typically a matrix like this in a cap-weighted world would be 0.93, 0.95. So you put all these outstanding performers together that then only have a 0.6 correlation to one another, and you wind up with just a fabulous risk-adjusted return, and your Sharpe and your Sortino ratios go way up versus what it would be in a static kind of portfolio environment. So this is a specialized portfolio that we've created that's available through many different outlets. We have a number of different portfolio blends that we've put together over time that we offer to advisors in many different wrappers that achieve myriad different objectives. But we're also going to talk about one very specific use case today that we created for the advisor that wants US large cap exposure, but just would like the opportunity to do a little bit better than just buying, the SPY, for example. So we took, we put our team together and had Arun Soni, who is the creator of multiple different BX strategies, and tasked him with creating a blend that would be basically a 99 correlation to the S&P, but outperform it over time. So Arun, could you tell us what we've created?
Thank you, Chris. So the objective of the BX US large cap model is to provide generalized exposure to the US large cap market segment. What does that mean? That the model should move in lockstep with the market. Basically, the curves should mirror each other, but the model's curve is going to be generally higher than the market across any different market periods, and we always evaluate over a market cycle. And so this model is comprised of two. So the model takes three different, you can think of it as 3 pillars. There's a size pillar, and then there's a dividend growth and yield pillar, and then there's a price momentum pillar. So these are through 2 different underlying sleeves. The first sleeve is a size sleeve where we just use market capitalization to build a large cap universe from the biggest 500 stocks as we define them. And then we build an index of 50. So it's diversified enough. It's risk diversified. We don't care for position diversification. And in all cases, we tend to always try to mitigate cognitive errors that are inherent in the data. So if you're in a size-based index, which is market cap, we know there's a lot of few outliers that can have undue influence on the large side, and then there'll be a long tail that do nothing for that exposure, but will just create a lot of noise. So we have documents that can discuss the grid in detail, but basically we truncate and control the undue exposure the large ones will have. They will still have an outsized influence, but not as much as they would if left untreated. And we find a very systematic way of cutting the tail. So we end up with 50 stocks, an index that has a very high correlation with the market, but has a consistent outperformance. Our generalized simulation, and this index has been live for 3 years, is long-term excess return is 2+%. So it gives you very much large cap exposure and moves in lockstep. The second pillar is the dividend yield and momentum uh, sleeve, that itself is made up of dividend growth to give you exposure to income stocks in the large cap US, and then the second pillar is the ones with price momentum. So these two, because dividend yield is a specialized value strategy and price momentum is a growth. When you put them together, we get two sleeves that themselves are quite uncorrelated. When they put it together with the large cap, you now and one thing to mention, the dividend yield and momentum index and the large cap core both have very similar performance, but the beauty is they access this performance from very different parts of the US market. So the kind of stocks that they hold, the kind of sector exposures they have, the kind of dividend yield that they have are very different. In fact, the dividend yield and momentum actually outperforms the underlying size-based index, but both are both are quite similar. So the return curves overlap each other, but if you were to look at the exposure curves, they'll be very different. So when we put it together, you get now a nice blend of three different pillars: income, growth, and size. And then the ensuing large cap model still shows that large cap exposure, but as you can see, that when the market has very high correlation, cross-sectional correlation, as you can see from 2015 to 2020, everything was running at correlation of 1. The best thing is to very much closely track the market until we get to a period like COVID, where suddenly there was dispersion and now stock picking becomes possible. And then the models automatically did that. And you can see that the model pulls away slowly and steadily away from the underlying index. So it gives you a large cap exposure with the potential to outperform. It's still diversified. In totality, this model will hold 80 to 90 stocks. So if you do tax loss harvesting, it's good for that as well. And we believe it's a nice positioning for anybody who wants US large cap exposure with strong correlation to the market, but with a bit of excess return if you just don't want index performance. So that's the objective, and that's how we built it, but very much in line with how Chris described how we build models.
Thanks, Arun.
Thank you, Aaron, and thank you, Chris and Craig. So at Index One, we offer a holistic index calculation platform that delivers fast, flexible, and scalable indexing solutions. And our platform supports fully custom strategies with tools for backtesting, index calculation, rebalancing, corporate action processing, and distribution. And we calculate the BX US large cap core and US dividend yield plus momentum indices on our one index calculation platform and disseminate the index data to BX. Oren, Chris, or Craig, could you share your experience setting up these indices on our platform and how you leverage the index data that we provide to create and implement these index plans?
I can talk to the actual mechanics of using the platform. So, I mean, it's central to our process for creating the individual sleeves, because we are able to create the exposure baskets, and then Index One platform helps us backtest them. And then once we are happy with the model itself, we can create the live index directly from the backtested strategy, and we can outsource completely the corporate actions, the daily not rebalancing, but the daily movement of weights based on price changes. And then Index One also has APIs. So using Index One APIs, we are able to ingest the portfolio structures as well as the index values on a daily basis, end of day, automatically. and we can then connect them with our partners, clients. We can send it directly via Index One if we wish, or we can send it via our infrastructure. So for us, Index One is very central to our process of uh, researching and backtesting the strategies, and then creating the live indices, and having Index One run the live indices and running the independent calculations. So we are responsible for the portfolio strategy, but Index One does all the calculation independently.
Yeah, and I'll just add that as a very kind of large warehouse of outstanding index ideas, the BX is. I'll say that Index One has been a fantastic partner for us. They've been very flexible, very innovative, and very easy to work with. So, just from my perspective, that's my 2 cents there, G.
Thanks both. Thank you. Amazing. Well, this is obviously a very exciting index blend, and I know you guys are working on more as we speak. So we're very thrilled to showcase it to investors who might be interested in incorporating index blended strategies into their portfolios. Chris, how would you explain how an investor can gain exposure to this index blend?
There's a number of different ways for investors to gain exposure to these and the other index blends, but without knowing which specific slices of technology that the advisor leverages without speaking to them, I can't recommend the best course of action for just a generic client, but a very quick conversation with BX, and we can figure that out with you.
Awesome. Great. That's yeah, and obviously if anyone has any questions about the indices that we're calculating on our platform as it relates to BX strategies, feel free to reach out to us and we can put you in touch with BX as well. We're always proud to support BX by enabling the end-to-end life cycle of backtesting, calculation, maintenance, and distribution for creating index blends that's used in direct indexing platforms, SMAs, and investment portfolios. We calculate over 80 indices for BX, and they each serve as a building block for a well-structured and consistently high-performing suite of investment strategies. So we look forward to continuing to nurture this partnership and advancing an open architecture of technology and providers in the space. We will now move into the Q&A portion of the webinar. To our audience, please feel free to submit your questions in the chat box and we will address them as they come in. Okay, we have got a question from Badami. Very informative. BX has some very interesting strategies and index funds offerings, very detailed and in-depth. Thank you for this discussion. Thank you, Badami, for participating. In the meantime, while we wait for questions, is there anything that you guys wanted to highlight or talk about? Anything that you're working on at the minute?
Yeah, I think something worth pointing out in as much as just demonstrating how innovative that BX can be, and Arun's going to speak to this in a second, but we've recently launched a suite of risk-aware crypto indices where the underlying investment is the Bitcoin ETF, but it's tactical, so there's asset allocation involved. But both of these are going to demonstrate hopefully returns like Bitcoin over time, but with much lower drawdowns, which is exactly what advisors want, to get a little bit of that turbocharged upside, but maybe a little bit of protection in the event of the gigantic drawdowns that you're typically going to see in the crypto market. And Arun is the author of one of these strategies, so we'll have him get on and explain his.
Yes, as Chris said, I mean, the general notion when we talk of equity markets is time in the market, because it's actually difficult to time the market, and missing a few of the very good trading days can actually make a very large difference to the returns you can get. But in our research, we found actually in crypto that doesn't really work well. It's actually spending time out of the market when it's in that huge drawdown period is of immense value. So we know there is interest in allocating small portions to client portfolios, but even in small allocation percentages, the massive drawdowns, the massive volatility of Bitcoin, for example, would be too much to handle. So we went about creating risk managed Bitcoin strategies. What does that mean? That will still use because the IBIT, the Bitcoin ETF, basically tracks the underlying spot Bitcoin. So basically, you want exposure to Bitcoin because you don't want to miss the massive upside. But if you can identify, which is what we are good at, the periods in which it's in its in let's say a bear phase, what we do is we have a minimum allocation to Bitcoin and a large allocation to a risk-free ETF in varying allocations. And what that does is it still maintains a minimal allocation to Bitcoin. So even through in a bear phase when there are rallies, you keep getting those. And then when the signal comes, it launches into a higher and higher allocation to get full participation. And the result of that has been that, and the two strategies that comprise the Bitcoin model have a very different way of allocating the risk managed approach. So they themselves are different to each other. So again, when blended together, they mitigate the weaknesses of each, making the Bitcoin model a very robust way to get Bitcoin exposure without experiencing massive drawdowns. For example, this year, the drawdowns for the two underlying strategies is in single digits, whereas Bitcoin is almost 30% down. So that just gives an investor the confidence that I can allocate, I can get exposure to Bitcoin, but don't have to have client portfolios go through these wrenching drawdowns. And it's just an extension of the way we blend underlying strategies, as well as how, what Craig mentioned, how we find the underlying ingredients that are going to deliver the objective. So the objective that two strategies must deliver Bitcoin exposure in a risk managed way, and then a way of blending them together to create a model that does it in a better way, because we've got two good ingredients that are fairly low correlation with each other to blend them together.
Thanks, Aaron. So we've got another question from Badami. To Chris, Craig, or Oren, how do investors view your diverse indices versus the standard market cap weighted indices? Don't you think these indices deserve a larger space in the, for example, in ETF space or mindset? Want to understand your broad philosophy on this. Thank you very much in advance. Thank you, Badami. I don't know who wants to take that question.
I think Craig.
Yeah, I'll start it, and then Chris can weigh in. It's this notion of what are investors looking for. So there's this trend that investors were looking for more passive investments and just sort of keep in line with benchmarks rather than try to beat the benchmark. And what we've kind of forced that thinking to say, if you find really good managers that do things on a differentiated basis, that are systematic, that have really good research and algorithms, can we put that into a structure that we compete with maybe standard benchmarks or standard indexes or passive ETFs? So we think there's a place for both. We'd like to think that you can have a good core, and then you can have some more active strategies around it that will not only lower the overall risk of a portfolio, but should over a market cycle enhance the performance. So the answer to your first question is yes, and the answer to your second question is between BX and Index One, we're actively looking for not only ETFs that we can use in our models, but also looking to place some of our strategies into ETF structures. So thanks for your question.
Yeah, I'll throw a little bit more on top of that, which is that, one of the reasons that Craig and I set out to build BX a few years ago was a fundamental belief that the shift towards passive had been overdone, and that advisors deserved better choices than simply taking these allocations of cap weighted ETFs or mutual funds. And if you think about it, two things can't be true at the same time, which is that active managers on average outperform, and that everybody else is doing as well as the market. Because if active discretionary managers underperform on average, which they do, and there's huge chunks of money in passive that's matching the market, mathematically, to me, that says there's outperformance out there to get everybody to average in at the average, and we set out to grab that outperformance.
Amazing. Great. Well, I think that's all the questions we have for today. So we can wrap this up and thank everyone for participating. So to our audience, thank you so much for taking the time to tune in, and we hope you learned something new. Be sure to subscribe to our email newsletters to stay updated on upcoming video content. And as always, feel free to reach out to us through the email addresses and websites listed on your screen. And Chris, Craig, and Aaron, thank you so much for joining us today. And we look forward to seeing everyone next time. Thanks, everyone.
G.